What if I told you that crypto investing doesn't need to be overwhelming? If you are a serious investor looking at crypto, you might be thinking you have to watch the markets every hour or at least every day to avoid catastrophic losses. The 24/7 volatility, the endless Twitter noise with random people screaming out in caps lock that this coin is going to the moon, he or she found this hidden meme coin. This is complete nonsense. Here's what most people miss. The investors making real money in crypto aren't glued to the charts. They understand the 5 macroeconomic factors that drive the majority of the price action in crypto. If you master these factors alongside your crypto portfolio allocation and have a regular weekly to monthly discipline of looking at what's happening on the charts and in the global macroeconomic environment, you are set to succeed in crypto investing. And today I'm showing you exactly how to transform crypto from a speculative gamble into a strategic, calculated investment. Crypto no longer is an asset to ignore. Over the past years, it has grown significantly and has now reached a total market cap of approximately $4 trillion. Sounds like a lot, and it is a lot. However, relative to other asset classes, like we can see here, gold, for example, which is at 20 to 25 trillion, the S&P 500, which is close to 50 to 60 trillion, as well as the US residential real estate, which is over 100 trillion. The cryptocurrency market is still comparatively small and new. That's why current adopters, especially institutional adopters with serious capital, are still considered early adopters of the cryptocurrency world, as the market cap is still relatively small compared to other sectors and asset classes. Since the bull market of 2021, institutions have started coming into the crypto space and now pretty much dominate at least the Bitcoin part of the cryptocurrency world in this 2024 to 2025 bull market. And this has fundamentally changed the game in crypto. It's not some hype asset class that moves based on social media posts. No, it's now in fact a major asset class which moves based on legacy financial rules such as macroeconomic conditions. Let's dive into the 5 macroeconomic factors that drive crypto markets. The first one is monetary policy. Monetary policy includes interest rates as well as any quantitative easing or quantitative tightening policies that global central banks execute. Most importantly here are central bank interest rates. If interest rates fall, the cost to borrow money goes down. In the end, more companies and individuals are looking to invest in real estate, in business expansion, and consequently the money in the world or the global money supply M2 rises. On the contrary, if interest rates go up, that means that cost of borrowing goes up as well, which reduces business expansion activity as well as personal investments into real estate and other asset classes, which in the end reduces the global money supply. When we look at the current situation which we are in 2025, we can see that we are from the interest rate curve, we are on a bullish cycle because the interest rates are expected to fall over the period of the next 1 to 2 years. As we can see in this tool here, the expected rate by end of 2026 is between 2.75 to 300 basis points or around 3%, while currently we're still between 4 to 4.25%. So that is a strong decline in rates, which overall signals a bullish market cycle, which overall signals a positive macro environment for risk on assets such as stocks and cryptocurrencies. When we further look towards quantitative easing and quantitative tightening policies, especially by the Fed, which is the Federal Reserve of the United States or the leading global currency, we can see that currently the Fed is still applying quantitative tightening policies, meaning they are currently reducing their assets on the balance sheet, as we can see in this Federal Reserve FOMC statement, which they publish every once in a while once they make changes to their policies. This results in a decline of the assets on the balance sheet of the Federal Reserve, as we can see in this chart, which had its highs back in 2022 and since then has seen reduction of its balance sheet size. However, we can see that the rate of decline has slowly but surely come to a halt, and we're basically now looking towards an increase in the balance sheet size of the Fed as the deterioration deterioration is coming to a slow halt. In summary, for the monetary policy, we can clearly see that when borrowing becomes cheap and cash basically yields nothing in the bank or with government and company bonds, capital flows into risk-on assets such as stocks and crypto, especially crypto, which has historically shown a very close correlation to the money supply and interest rates. Digital currencies become even more attractive. When the Fed, on the contrary, raises the rates, suddenly treasury bonds at 5% yield look pretty attractive in comparison to some digital currency. The second is the fiscal policy. Fiscal policy means a variety of things, but overall, these are policies initiated by the government, specifically related to tax and government spending activities. If we currently look at a chart which shows the US deficit in 2024, basically a comparison between revenue and spending, we can see that their revenue falls significantly short of the spending and leaves a deficit of around $1.8 trillion. And this deficit is growing by around 2 to 4% per year recently, which is definitely something to consider, which is concerning for many institutional investors. What we can see is, based on this huge deficit, the total debt is really increasing in terms of GDP. And if we look at the top nations by debt to GDP ratio, we can see that the United States is ranking quite high at the moment with over 130% debt to their annual GDP, which is massive. And this debt spiral only gets more intense the higher the total debt rises, because interest on that debt that the United States has to pay is increasing drastically. As of 2025, around 1/7, which is 15% of the total annual budget of the federal government of the United States, is used just to pay back the interest for all the debt that they have received from institutional investors through the government bonds. And that is massive. And in the end, this constant money printing and the increasing debt to GDP ratio is definitely concerning, because at some point the monetary policy might not be unbiased or unpolitical anymore as it is currently, which very likely is going to result in a constant money printing, which is aiming at reducing the interest on outstanding debt for government. And this in the end leads to this chart where we can see the buying power of the United States dollar decreasing, which is a result of inflation and the currency debasement based on constant printing. Meaning holding US dollars as an asset is the worst decision that you can make as an investor, because you're constantly losing purchasing power. Other important factors within fiscal policy are tax-related matters. And a very important bill was passed in 2025, which was called the One Big Beautiful Bill by the Trump administration. And this bill specifically aims to prolong tax cuts originally granted by the Republicans back in 2017, and even eliminating any tax that waiters or any other person receives based on tips. And tips is a very significant income source for many Americans, whether it's waitresses, people working in restaurants, or Uber drivers, or any kind of other people relating on tips, bartenders. So this has a huge impact. And to fund this, and it is projected that this bill alone will add trillions more to the US debt over the coming 5 to 10 years. And now we need to talk about the third aspect of global macroeconomic factors driving crypto prices, which is the role of the US dollar. The US dollar is the global reserve currency, meaning it's the most important currency that many investors and institutions across the world look at on a daily basis. And the role of the US dollar basically is the safe haven and the world's reserve currency. So many other nations, as well as private institutions, hold the US dollars in their reserves, or in different words, hold government bonds in their reserve, which make the development of the US dollar strength against other currencies very important. And basically what we can say is that if the US dollar weakens, investors look for higher yield opportunities, and they specifically look for risk on assets to gain a higher yield, because a government bond offering 2 to 3% return is just not enough for most investors. So they're looking at better opportunities, mostly in stocks and other risk on assets such as crypto. And when the interest rates are reduced, US Treasury yields are less attractive, which in the end reduces the demand for US dollar, and in the end reduces the strength of the US dollar. On the other hand, if we have global geopolitical tensions, for example, and the need for a safe haven increases, investors flock to the United States dollars, flock to US government bonds, and with that increasing the demand for the US dollar, which in the end results in a stronger US dollar. So that is very important to know. In 2025, we have seen that the US dollar has already dropped 10% in its strength versus other currencies, meaning other currencies gained in value while the US dollar dropped in value. And this is very similar to Trump's first term, where he he deliberately undermined the strength of the US dollar to strengthen US exports. Based on analytics, 99% of you watching are not subscribed. If you find this video valuable, please subscribe for more institutional grade crypto breakdowns. It would really help the channel out a lot. And let's dive back into the video. Now we need to talk about the fourth aspect and arguably the most important aspect, which is global liquidity. With global liquidity, we mean the global M2 money supply, which is the sum of global liquid assets, which basically means all the cash at hand or investing vehicles which can be readily converted into cash. And the M2 money supply is already heavily influenced by the previous aspects that we have mentioned, such as the monetary and the fiscal policy, as if, for example, interest rates drop and people get more loans, the global money supply, of course, is increased. So in the end, the money supply is often a result of these other activities, such as the monetary policy and the fiscal policy. But what is important to know is when global liquidity expands, when central banks collectively pump money into the system, the money has to go somewhere. So asset prices almost logically rise with monetary expansion. And crypto is very strongly correlated to the M2 money supply because it's the most liquid market and it's open 24/7 and it's global. Historically, we have also seen a very strong correlation between the S&P 500 or other stock market indices and the M2 money supply. While deviating on a yearly basis over the long term, it's very much the same story. And what we can see here is exactly what I'm talking about. Crypto has a very high correlation to the money supply, but more specifically, not to the absolute growth in dollars, but to the percentage growth change. So the first derivative, which basically shows that if we have an increase in the money supply growth rate in percent, it's good for crypto prices. And if we see a decrease in the money supply growth rate, that's a bad signal for crypto markets because it's the first indicator of a more hawkish, more bearish global macro sentiment. And one other aspect that we haven't touched on so far, which influences global money supply, are other factors which might not get as much attention but have huge impact, such as recalibrating the minimum reserve rate that banks have to hold as collateral against loans. And if that's changed, of course, banks can issue more loans or can issue less loans. In this case, they can issue more loans, which is a very bullish signal for global liquidity. What we can see over the past years, while there was a dip in global money supply back in 2022 and 2023, where the central banks raised interest rates very aggressively based on the hyperinflation that we have seen across most Western countries. The money supply consequently dropped, but has now increased again and actually has surpassed the highs of 2022. And now let's look at a fifth aspect that drives crypto prices, which is regulation and policy shifts. This is very important to understand because this is basically the wild card, which many people do not see coming most of the time. And for crypto, some of these include the Genius Act, which was passed in 2025, which basically regulates stablecoins and also drives demand for the US dollar. It's a very bullish signal because it solidifies the institutional grade investing level for stablecoins and for crypto consequently, which again is a good sign. We also have seen the passing of the US Clarity Act, which specifically regulates layer 1 blockchains and consequently creates more demand for layer 1 blockchains. Eventually, US Clarity Act also enables more ETFs to be easily approved for layer 1 blockchains, and that's exactly what we can see also in the ETF roadmap, that all of these crypto assets that we have on the roadmap are actually layer 1 blockchains, which the reasoning behind is based on the Clarity Act that we see here. Other important regulatory changes in 2025 include the executive order from Donald Trump, which paves the way for crypto assets such as Bitcoin to be incorporated into 401k retirement plans. And as you can imagine, fund managers for 401k plans have massive amounts of capital at their disposal, and paving the way for including crypto in these retirement plans is a huge step towards institutionalizing the space even further. Additionally, ETF approvals have resulted in a huge inflow of capital. And we look at Bitcoin alone, we have seen over $140 billion in assets under management through these crypto ETFs, because it's just way easier for everyday investors to invest via ETFs with their existing stockbrokers rather than opening completely different accounts and getting to know all the crypto language, etc. So that has boosted the space dramatically. And lastly, what we can see is a strong increase in inflows by ETFs. Additionally, what we have seen, ETFs not only touching Bitcoin, but also Ethereum, Solana, and slowly but surely other layer 1 blockchains where institutional investors are looking to deploy their capital into via ETFs. And furthermore, we have seen public companies increasing their accumulation of Bitcoin, such as MicroStrategy, Tesla, SpaceX, and many other companies, which we can see in the bottom left chart, which actually shows the strongest growth rate of total Bitcoin held, which is for the public companies. As you have seen, crypto doesn't move on Twitter hype or short-term news. Crypto markets are driven by the same macroeconomic factors that have driven stock markets for decades now. However, just in a much more volatile fashion, as the total market size in crypto is just that much smaller as stocks, for example. For you, in order to succeed in the crypto markets, you need to watch the Fed's meeting minutes rather than Twitter influencers. You need to monitor the DXY strength and the global money supply growth rate. You need to pay attention to policy changes and watch institutional accumulation rates like a hawk. You need to watch ETF inflows and understand the policy lag effects, which is generally a time period considered to be between 6 to 12 months. And of course, you have to adjust your portfolio size and positioning based on these macroeconomic factors. In our crypto investing masterclass, Beyond the Market, we work with high net worth individuals to set up their crypto portfolios for success. In weekly live market breakdowns, we cover exactly the changes we see on the global macroeconomic front and how to position your portfolio accordingly. If you're interested, click the link below to learn more. Crypto is no longer a speculative gamble. It's a macro asset. And like all macro assets, it follows the rhythm of central banks, fiscal policy, and regulation changes. And these investors who understand the principles and monitor them, they will likely outperform those who don't. And answer me one question. If you could only track one of these 5 factors that we've discussed in this video, which one would it be? With that, cheers. See you in the next one.